with governments running up enormous fiscal deficits resulting in soaring national debts, while central banks eagerly provide liquidity through their digital currency creation, there has been much talk of the prospect of hyperinflation, or at the very least double-digit inflation. In such a scenario, what would this mean for mortgages? Well, the answer isn't quite as simple or as straightforward as we may like to hear. So let's dive on in and find out. Now, this channel provides global macro insights for informed investing, so do consider subscribing. So let's remove ourselves from the traditional perspective of inflation being an increase in the supply of money and credit and the resultant increase in prices. Instead, let's focus upon the consequent impact only, and that is the general rise in prices. Inflation from a government and central bank's perspective is a lot like the porridge and Goldilocks and the three bears. Not too much, not too little, but just about right. Why is this, and why are we right to expect inflation? Well, it all breaks down to the amount of debt that our economies possess. Whether it's households, corporations, or even the government, the sheer volume of debt means that our current economic system will break down in the face of prolonged deflation. It would lead to mass mortgage, corporate defaults and banking crisis before ultimately we would see our governments default on their obligations. Why? Well, it's simply because the real size of the debt increases if the actual purchasing power of money rises in a deflationary scenario. The clearest example of this is from the aftermath of the Wall Street crash, which saw mass defaults and bank collapses in the face of a prolonged deflationary depression. Instead, latest FOMC minutes refer to the fact that the Fed, and this goes for other central banks as well, are happy to let inflation run higher than 2% in coming years. But this is likely to run considerably over that as any potential recovery takes place. And what's more, the failure of central banks to normalise their monetary policy in recent times tells us that central banks will be incredibly tentative in dealing with any suggestions of inflation running too hot. Indeed, the inflation tax will be the primary means used to actually repay the excesses of our governments over the last 50 years or so, particularly the last few months. But the problem for central banks will be in maintaining confidence in the currency. Indeed, a primary factor in determining hyperinflation is the velocity of money, which, as we've discussed previously, is a psychological phenomenon. The lower people's confidence in the currency, the more quickly they actually rush out to actually spend that money. But it also depends upon where the new credit creation goes. When it goes straight towards deficit financing, that money is spent immediately and doesn't simply act as reserves for commercial banks and promote asset price inflation. So if confidence completely fails in the authorities and velocity runs ever higher, we may well see much higher broad inflation. But this scenario is going to be bad news for most, as nominal wages will certainly lag strong price growth. Therefore, there will be a decline in real wages. The higher the inflation rate, the greater the decline in real wages. Yet this process will serve to actually reduce the real size of all of these debts. This is true for households, firms, and for national debts as a whole. If these price rises can be restrained and that velocity of money does not go too high, then the authorities will welcome such an outcome. Normally, the attempt to restrain price growth occurs through higher interest rates, of course. The problem here is that with such vast debts, higher interest rates make these debts completely unaffordable to service. Hence why the Fed has announced that interest rates will remain near zero until at least 2022. Yet if we were to begin to actually see runaway, uncontrolled and devastating inflation of the type we saw in the Weimar Republic or more recently in Zimbabwe, what may happen to mortgages in such a scenario? Well, in the immediate term, the real value of these debts would be greatly reduced, of course. However, such a scenario imposes major problems for the banking sector, as the real value of the debts decline at the same time that the bank's operating costs are likely to rise, and this would include wage demands of all their staff. This would cause a wave of bank collapses and require the central bank to step in to provide emergency funding. Ultimately, with all hyperinflations, a complete reset of the system is needed, which restores faith and trust and confidence in the authorities once again. In the Weimar Republic, the Rentenmark, or mortgage mark as it was known, was introduced and was backed by bonds indexed to the market price of gold. And this did help to actually restore confidence and stabilise prices. So what happened to people's mortgages following this revaluation in the Weimar Republic? Well, some debts were reinstated to compensate creditors partially for the catastrophic reduction in the value of the debts that had occurred. Indeed, a decree in 1925 reinstated some mortgages at 25% of face value in the new currency. This was effectively 25 billion times the actual value of these debts in old paper marks. Meanwhile, some government bonds were reinstated at just 2.5% of the face value of the new currency. The reinstatement of debts and resumption of effective taxation in a still devastated economy triggered a wave of corporate bankruptcies. Here the government argued that they were trying to actually balance the interests of creditors and debtors simultaneously. The calculation of conversion was judged to the dollar index as well as the wholesale price index, so as to roughly indicate the true price level over the inflationary period. Meanwhile, Zimbabwe endured inflation as high as 231 million% in 2008. For a less economically developed country, it makes sense to actually break down the debt into three different categories here. The first form of debt being asset-based debt, where you owe an asset, being a car or a piece of land. Now, non-cash interest was also applied, which could include produce from the land, for instance. Importantly, this form of debt was not erased through hyperinflation. Secondly, there was foreign currency debt. Those owing this form of debt were perhaps hardest hit as a consequence of Zimbabwe's hyperinflation. This is due to the massive depreciation of the Zim dollar versus foreign currency. Consequently, the dollar-based interest payments and the principal sum increased substantially as the Zim dollar plummeted in value. Third, well, there was domestic currency or Zimbabwe dollar debt, and this is where the real madness of the situation began, and debts were quickly eroded through such high inflation. Yet after the economy dollarized, that is, adopted partial dollarization, the impact was to vastly inflate the value of the real debt to the extent that, according to Zimbabwean contributors on Quora, that many years later you still had some people trying to actually repay things such as their electricity bills. So how likely are we to see hyperinflation? Well, I think we remain a long way from the complete death of money yet. If we think for a moment about the key components of all hyperinflations, it comes down to three clear factors. As behavioural analyst John Mortier pointed out in a 2013 paper. First, there must be a supply-side shock, such as the Second World War or farm seizures in Zimbabwe. Second, a high level of foreign currency obligations, which requires ever greater printing as the currency depreciates in value. Third, a vicious circle develops which supports even higher prices. Commonly, this occurs through increased wage demands, which drive up prices and lead to further increases in wage demands yet again. Nevertheless, the lessons are clear. While high broad inflation may be good for debtors with fixed interest payments who thereby avoid higher interest rates, hyperinflation and the complete destruction of currencies will see debts revalued in the new reset currency. As in the words of Montague Norman, former Bank of England governor, capital must protect itself in every possible way. Unquestionably, the bankers will make sure that they actually get their dues. Now, thanks so much for watching. Do consider subscribing and check out these other videos here, and I look forward to seeing you next time. Bye bye.